fellow investors, and welcome to another episode of Ritter On Real Estate, where we teach you how to passively invest like a pro. Today, my guest is Jennifer Beadles. Jennifer has over 250 units across 7 states. She was just telling me before the show how they just got back from a stint over in Europe, and they've been to, I think, 28 countries over the past few years. So obviously she's fulfilling the goal of living a financially free life and traveling the world on her real estate. So Jennifer, thank you so much for being here. We're excited to have you on the show.
Thanks, Kent. I'm super excited to be here and share my story today.
Yeah, absolutely. So let's start there. Let's start with a little bit more about who you are and how you got to be where you are today.
Yeah. So I'm originally from Seattle, Washington, the Pacific Northwest. And for about 9 months, I've been in Phoenix, Arizona. So we recently relocated. But prior to that, we spent about 18 months traveling. And so we landed here in Phoenix. But I became an investor. My first investment was purchased in 2007. And the first, I would say, maybe 5 years, we kind of dabbled between spec home building, flipping, doing just kind of a lot of random projects, really just trying to figure out what niche would be the most profitable for us. My husband was in the construction industry. I had gotten into real estate working for a builder in 2007. So really, we just kind of went all in. But we found what really would provide us the lifestyle and the freedom that we were after was small value add multifamily. And so for the first 9 years, we actually just stayed in our own backyard, investing north of Seattle, again, doing some small multifamily building. We were doing a lot of BRRR deals, so buying really ugly properties, fixing them up, refinancing them, having cash flowing having tenants pay the mortgage, of course, high cash flow. And then when the cap rates started to get, really low and the deals kind of started to dry up, in our local market, we started to look outside of Seattle. We actually made our first investment in the Indianapolis area, right in your backyard, Kent,
Yeah,
in
go Indy.
in Greenwood, Indiana. Had never been to Indianapolis, knew nobody in that market. Had bought this duplex sight unseen. I think it was like 155,000. We spent about $19,000 on the renovation. Crawl space remediation, attic remediation, full interiors. We ended up renting it out for, I think it was about $22.35, and realized for the first time that we could actually scale this model. It was something that, again, prior to that, my husband was managing these projects. We were self-managing. And that really kind of, I guess, provided that proof of concept for us, which was we can actually, again, scale this outside of Seattle. We don't have to continue to invest locally. The real estate was so expensive in our local market. And so now we're actually in 8 states. We just closed a deal in Kentucky. I know it's another market that you're in, just last week. And so we're at about, I think, 281 units in 8 different states. But what real estate investing has allowed us to do is essentially have ultimate freedom. And so that, there was no longer any need for us to live in Seattle. So, we kind of asked ourselves that question is, why are we living here? We don't enjoy the rain. We don't enjoy, the climate and the weather and the traffic and, the expensive market. So we were able to relocate here and then just continue investing all across the country.
Wow. Well, that's an awesome story. And I think you guys have been able to very quickly scale up. You've been able to do some things that are probably pretty scary to most that we want to talk about. But it sounds like you've gone through a few different approaches, a few different strategies, right? A few different asset classes. So, um, what made you eventually land on kind of these, I'd say, small to mid-sized multifamilies? Like what was it that draw you to those properties?
Yeah. There was a moment in, I would say, I think it was maybe about 2015. And my husband and I, we had a lot of rental properties. And the purpose for us investing was to actually fund our ideal lifestyle and have some freedom. And there was a moment, I think it was Memorial Day weekend, and we were having a big barbecue at our house and everyone was over. And then we get a call from a tenant that there's something wrong with the septic. And so there's basically like septic coming up through the bathtub. And,
Mhm.
it was a pretty big urgent issue. So my husband's on the phone trying to call an emergency plumber. He ends up leaving the barbecue and going over there to try to troubleshoot what was going on. And then when he came back, everyone had left. And we looked at each other and we said, I think we're doing this wrong. I think we've
Mhm.
somehow, the purpose was to have freedom, but we have no freedom. If we can't enjoy a barbecue on Memorial Day weekend, then obviously we're doing some things wrong. And so we really kind of sat down and clarified the purpose and clarified the direction that we wanted to go with our lifestyle, and also, with getting some clarity around what types of investments we wanted to be doing. And so at that point, we stopped flipping. We realized that that was another job. We realized that we couldn't, go leave on vacation and, again, have this freedom, because we needed to manage these projects. It was just a lot of work, a lot of time and effort, very, very profitable, of course,
Mhm.
but it just took a lot of time. And so we said, well, what would it look like if we did bigger multifamily projects, very similar to how we run these flips, but other people do the work and we're just kind of playing asset manager as opposed to operator. There's a really big difference, kind of, as between
Yeah.
asset management and operations.
Mhm.
And then, also having other people source and find the deals for us. And so we really we stopped spec home building. We stopped pretty much anything that was kind of working as an operator, and
Mhm.
essentially trading, time for money, and focusing more on, again, asset management and investing. And so it was really clear to us that the path was these value add multifamily properties where we could essentially, acquire the asset, add value, improve the NOI, reduce the expenses, increase the revenue. And then that also allowed us to control the value of the asset. So up until that point, we had mostly stayed residential. So we were
Mhm.
buying, duplexes, triplexes, fourplexes, and that was really our bread and butter. We really understood how the financing worked. We had a loan strategy where he would buy a property and put it only in his name, and then I would buy the next property and put it only in my name, so that we could get 10 conventional loans each to get to our 20 max. And so we really just kind of stayed in that lane for quite some time until we realized the power and the ease of getting these commercial loans, and
Mhm.
then how easy it was to refinance, essentially once you've improved the value, of course. And so then we started moving and gravitating in that direction.
Yeah, I love that story because it's I think it's something a lot of us go through, right? I went through a similar story of doing fix and flips and single families and different things, and then graduating to multifamily for a lot of the same reasons. But you called out just the scalability, the ability to have third party management, right? The ability from a financing standpoint, like you said, it actually becomes easier to get financing and then
Mhm.
refinance. And then you called out forced appreciation, right? This idea that you can
Mhm.
actually control the value by increasing the income. And so I think you hit on a lot of key points for reasons to move to commercial real estate.
Mhm.
And I also like your story because a lot of times we hear about, I think a lot of the messaging that I hear, whether it's on social or other places, like you got to go big, you got to be 100 plus units, you got to kind of go after these monster projects, um, which can get people, kind of over their skis pretty quickly. But you guys were able to scale, I think, in a very thoughtful way to,
Mhm.
like, what would you say, like about 20 unit properties, things like that, that's still relatively small, still kind of a nice pocket. And we'll talk about more of your strategy around that in a little bit, but enough scale to give you that freedom and allow you to, like you said, step back as an operator, be more of that asset manager. So I really like that. Sounds like you guys have found a really nice pocket there that, again, it's given you. And you talked about clarifying your goal as well and kind of understanding. And I think that that's something that, I've definitely gone back and forth on is, you get into it and you're into the day to day and you're like, wow, you're working really hard. but why are you really doing this? Right. And you're doing it for more freedom. So are you working yourself out of that freedom that you initially intended to
Right.
do? Right. And I think that's kind of the constant balance of scaling, and taking on different approaches. You got to sit down. You had that moment where the sewage is coming out of the toilet, had to leave the barbecue, your husband did, and really that checkpoint, instead of just continuing to plow forward, you guys were able to step back, sit down, kind of reconfirm your mission, and then realign your strategy with that. So I love that. I think that's something that everybody should be doing. Just you were just conscious enough to be able to think of that. So I took all that away from your story, I guess, is why I'm summarizing all this. And so yeah, I think there's a lot of lessons to learn there.
Yeah, well, and I think it's really easy for us now to make decisions on what projects we want to get into because we have a lot of like really interesting deals that come across our plate. And I
Mhm.
think as entrepreneurs, it's really exciting to try out, new areas of the business and get into, different
Definitely.
kind of like sexy projects, right? Or something that's really interesting. And but we always go back to this question is this going to get us to the next, level of the lifestyle that we desire? Which is again, we want to spend a couple of months a year, and we have been a couple months a year out of the country. And
Mhm.
so if we say, well, if we do this project, we're going to have to stay here and manage this project, then that's a really quick no for us. And so
Yeah.
again, we've turned down some really interesting partnerships and deals with really kind of interesting projects because again, for us, it's about that lifestyle and having that freedom, even just the little things of being able to drop our daughter off at school and pick her up at 2 o'clock in the afternoon
Yeah.
and pretty much be, quote unquote, done with work at
Yeah.
2 p.m. so that we can be out in the pool and doing family things. And
Yeah.
so, but getting that clarity is really important because I think it's really easy, again, as the entrepreneur to kind of get on that entrepreneurial roller coaster. And then you might find yourself somewhere that was really far off from the direction that you had initially intended.
Yeah, I really appreciate that because I mean, without that clarity, right? There's the
Mhm.
quote, if you don't know where you're going, anywhere will work,
Right.
right? Or anywhere's
Absolutely.
fine. And I think it's totally true. And I think you're right. As entrepreneurs, it's very easy to want to chase the next
Mhm.
shiny object, and that can
Right.
and take on too much. And so I what I
Mhm.
appreciate about your story is you have found, it seems, a very scalable
Mhm.
or very approachable way to get into commercial real estate and create a lifestyle
Mhm.
that meets all of your needs without trying to just continue to grow for growth's sake. Not that you're not growing, but I mean project size and taking on all
Mhm.
these different things, right? You've been able to stay very focused on the mission. So that's wonderful. I do want to get into some more specifics, just around your strategy and
Sure.
understanding your approach a little more. So you mentioned that you were investing in Seattle, you were investing in your
Mhm.
backyard, and you went and bought something in Greenwood, Indiana.
Mhm.
So I'm curious to understand. I mean, it sounds like it was really about seeking value, right? You said the
Yes.
properties in Seattle were so expensive, didn't have the type of cash flow you wanted. So you're able
Mhm.
to find that value in Greenwood, Indiana. How did you find the property out of state? And then talk about that process of going through and buying sight unseen, because that's super interesting. That gives me kind of a chill in my spine. So I want to know kind of how you go through that and do the due diligence offsite and kind of get comfortable with a property.
Sure. When it's so interesting as you're describing this, Kent, it does sound a little scary, and yet I do it every day. So
Yeah.
it's really interesting. And I think it really comes down to systems and processes and checklists. And so with that initial deal, the first thing is I was kind of asking myself, well, where do I want to invest? I wanted to invest in a market that was very, very different than Seattle. So I was looking for more, cash flow focused versus appreciation focused.
Hmm.
That's, one of the benefits of investing in, the West Coast or in Seattle was my appreciation rate is fantastic. And so
Hmm.
a lot of the properties, of course, were doubling every couple of years or so. And so the values are really increasing, which then allowed us to do cash out refinances, use that money to then invest in other markets.
Yeah.
And so I was first kind of looking into Indianapolis because I just heard a lot of investors talking about how great the returns are and that it's very cash flow focused. I also went back and, ran some analysis on how Indianapolis had performed in the Great Recession. And I noticed that it just kind of remained flat. There wasn't,
Mhm.
a lot of, price reductions, or prices had gone down like they had in Seattle. In some areas in Seattle,
Yeah.
prices had gone down about 30%. And so again, I wanted a market that was very different than Seattle. And so I found an investor agent. I, just basically went on realtor.com and looked to find agents that had multifamily listings. Found an investor agent, was really kind of open to different areas in the city. Again, I'd never been to Indianapolis, so I didn't really know what areas I should be investing in. And so I just asked the question, as I said, well, where's the hidden value? Where are the B-class neighborhoods that everyone wants to live, where the rents are going to be a little bit higher? I didn't want a super cheap property in maybe like a
Mhm.
D-class neighborhood where, it looked really cheap and the rents were really high, but the tenant quality wasn't there.
Sure.
Um, and so he had mentioned to me that Greenwood was a really nice area, B class, great schools. Prices were still relatively affordable, but rents were fairly high. And so I said, great, what do you have in Greenwood? He sent me that duplex. It had been on the market for some time. And so I was kind of wondering, gosh, is it that great of a deal if it's just been on the MLS for a while?
Right.
And so I think they might have been asking 200,000. We offered one, I think 165, and then found a couple things at the inspection and then got them down to 155. I was also shocked at how inexpensive it was to renovate. And so as mentioned, we spent about $19,000 doing all of the interiors, kitchens, bathrooms, flooring,
Yeah.
paint, crawl space remediation, attic remediation. That would have cost probably 50,000 at the time in Seattle. So, more than like half price of what we would pay. And
Sure.
so, but I felt like that was a really low risk investment. Financially a low barrier to entry getting into Indianapolis. And so that was kind of the first test, just kind of dipping our toe in the water of, will this work out of state? And then the other challenge was, well, so how do I oversee this project, right? It was big
Yeah.
renovation. And so I basically started interviewing property managers and asked if they would project manage, meaning they would, essentially help us get bids and go by and check on the work every single week. And the property manager said yes. I think we paid 10% for them to project manage.
Mhm.
And this is what we do now. I mean, that first deal just worked really, really well. And so we built that into our processes. So we only hire property managers that will do project management for us. So this deal that we just closed in Kentucky, we will rent it. It's just a 12-unit property. We will renovate every single unit. And the property manager is going to oversee that. So we already have the bids, and then they'll go by there every couple days, send us photos, give us project updates. And that's kind of how we handle these renovations.
Gotcha. So you is that essentially your strategy in each market, is to find a rep, find a buyer's rep, if you will, to
Yes.
source properties for you?
Yes. Yeah. So we work with agents all across the country. So I get deals in my inbox pretty much every single day that we analyze. And then if it's a deal that doesn't work for us, then we have an investor community that we'll share those deals with. And so it might, again, maybe not fit our criteria, but fits another investor's criteria quite well.
Sure.
Um, and so yeah. So then we have as far as like doing the due diligence. So a couple deals, even when we were in Europe for 9 weeks, we were performing due diligence on properties. Because again, we follow a checklist. I have a due diligence checklist. I'm happy to share it if anyone's interested. It's about like 4 different tabs of the different stages of due diligence.
Yeah.
You've got the financial due diligence, you've got the physical due diligence, lease audit, all of those things.
Mhm.
And so we basically just follow a checklist. And I have these agents kind of help us out with photos and video. Of course, we get property managers over there, when we're doing the third party inspections. We have the property managers show up and they'll kind of have conversations with the tenants and report back to us on, which tenants we might want to terminate leases on, which tenants seem to be great tenants that they think,
Yeah.
we could just do some rent increases and basically keep them on. And so between, the agent and third party, inspectors or the third party reports, all of the photos and video that we get with property management, it's pretty easy for us to make these decisions sight unseen.
Yeah, no, I love that. You've created again that model that gives you that freedom, right? It's kind of the quintessential who, not how concept of
100%.
figuring out who can do it for you, and being able to leverage all these different parties in different markets and create a network that can do all this on-site work for you and get you comfortable.
Mhm.
So I'm curious, as you're going after these properties, what is the deal structure look like? I mean, you guys have acquired, would you say 280 something units now?
Yeah, so it's 280 units total.
Okay.
And then, some of that is through syndication that we're GPs on, and then some of it's just JVs, and some of it we own 100%. So
Okay.
it really kind of depends on the deal. Ideally, the ideal structure for me is to own 100% of the asset. And
Mhm.
so, when the deal supports it, a lot of times we'll bring in a private lender, have them fund, close to 100% of the deal. We'll give them interest only
Mhm.
until we refinance. Most of the time, again, it kind of depends on the deal. Most of the time, we're able to refinance within maybe 12 to 18 months, pay the private lender back, and then we own 100%. So I've never been one that has a certain unit count that I'm after. I don't think
Sure.
that unit count is the best like metric for success, but I know
Kind
it's
of a
thrown
vanity
around.
metric, isn't it?
What's that?
Kind of a vanity metric, unit
Well,
count.
it is. Well, and it's really interesting because I have, large syndicators that have reached out to me that say, I'm just trying to syndicate so that I have enough money to do my own deals. And so, because they're not making a whole lot of money on the syndication side. And
Mhm.
so, anyways, so for me, it's, I would love to own 100% of these assets. But, the way that I structure that again is having a private lender fund 100%, or a group of private lenders fund 100%, and then I'll do the refinance them, or so do all of the work, refinance them out, and own 100% of the asset. Sometimes if the deal doesn't really work for that, then we'll do JV. And so we'll
Mhm.
bring on a capital partner who will come in, maybe they bring all of the capital, and then we split the deal 50-50. So those are kind of my two preferred methods. Other than, of course, we're just doing a 1031 exchange or something like that. We'll,
Sure.
exchange maybe some of our like residential properties that we own in
Sure.
Washington and get into apartment complexes. Mhm.
So when you're bringing a private lender in, do you mind sharing with us, what does some of the terms look like, and what kind of deal sizes does that work in? I mean, is there kind of a max number you've seen?
Yeah, it depends on the private lender. I wouldn't say that there's like a max deal size. I mean, I've worked with private lenders that had, $1 million to lend out or $1 million to work with. And so typically we're doing interest only, 24 months, and it's going to be anywhere in the like 6 to 8% range. And we just, pay them monthly. Of course, a note is recorded against the property. I had an attorney a couple of years ago draft me loan docs. We make it really, really easy for the private lender.
Mhm.
So essentially, the attorney just updates it based on the state that we're operating in. And then the private lender again funds the deal. We pay them monthly until we refinance them. So typically with that, we're not doing appraisals, we're not doing, loan fees and all the underwriting fees and things like
Yeah.
that. These are just individuals that are in our database, not necessarily like in the business of private lending,
Yeah.
though, that could be another option for people.
Mhm.
I know a lot of other investors, friends of mine that I know, they'll do like a private lender second. And so they'll
Mhm.
get a bank loan, have the private lender be in second position. And so they're doing 100% financing essentially, and then refinancing that. And that works too.
Mhm.
But I prefer to just, have first deed and have that private lender, finance it, and then basically just refinance them. So it's a great deal for the private lender because they get the collateral, of course, doesn't really require a whole lot of work for them. And then it's a lot better than what you can get, as compared to like a CD or, the stock market's way down right now.
Absolutely.
And so, yeah, so it's a great deal for the private lender for sure.
Absolutely. And those, I mean, those are pretty solid terms at 6 to 8%.
Uh-huh.
That's not bad. So
Right.
how did you develop this network of private lenders? You said it's not necessarily people that are in the business of private lending.
Right. Yeah. So I started hosting a meetup group in Seattle in 2016, and I highly recommend that everyone does that.
Hmm.
Essentially, it would just be once a month, and we started at a little local pizza joint. I think the very first meetup, maybe 6 people showed up, so it was really small.
Yeah.
And I just gave case studies on properties that I had purchased, what it looks like, what the process is. We, sometimes talk about different topics like related to financing, operations, due diligence, deal analysis. And so I would have a lot of people come up to me and they would say, "This is great. It sounds like a lot of work though. Can I just give you money and you just do what you do?" And then I get
Hmm.
a return on that money. And so I would say, be my number one source. I also used to buy properties at the foreclosure auction, and there was like a lot of standing around and like waiting for the trustees to come up and call out the properties. And so I met a lot of investors there as well. People who've been in the business for years and years and years.
Sure.
And so those are two really great sources. Of course, conferences, any kind of networking events, is really, really great place to meet private lenders. Mhm.
Yeah. No, that's a fantastic tip and resource that you've developed. So next, I wanted to get into a little bit about how how you manage these properties from afar, right? You've got properties in 8 states. You guys are traveling all over the world.
Mhm.
So talk a little bit about that evolution from more operator to asset manager. Talk about what's the difference, and then talk about a little bit about your systems.
Mhm. Yeah, so the difference between like an operator and an asset manager. So the operator is responsible for the day to day, right? So that would be pretty much the property manager's job. So the screening and marketing of tenants, making sure that everyone's paying, managing vendors, setting the rents, things like that. On the asset management side, it's all about basically, the return on investment. So looking at, ways to kind of the strategy, like the bigger picture, like how can we, increase the revenue? How can we decrease the expenses? What are the opportunities for forcing appreciation? Obviously, like watching, the current, debt that you have on the property, and the ability to, kind of either like refinance or in some cases sell, do, disposition with an investment.
Mhm.
And so on the asset management side, basically we follow up with the property managers every other week. Unless we have an ongoing renovation, and that's every week. So it's every single Tuesday. It's having conversations with their property managers or their team, kind of getting updates on how things are going. And then on a monthly basis, it's a P&L review. So how well are these properties performing? Are there any conversations we need to be having on these Tuesday calls with our property managers? Like, I'll give an example. Maybe tenants are not paying for utilities. We are, but there's an opportunity to do like implement rubs or like a flat fee bill back for
Mhm.
utilities. So that's something that a property manager may not like. They may not notice that, but we will on the asset management side when we're going through these P&Ls and saying, "Wait, why are we paying for this and not billing it back to the tenants?"
Mhm.
So things like that. And then the other thing, we update scheduled real estate owned every single month. And so basically it's updating, what the loan balance is, obviously looking at current rents, looking at any, potential renewals that are coming up. And then, I would say like, debt dates when the loans are going to need to be refinanced or sold, making decisions like that. And then I would say like biannually, we requote our insurance, making
Mhm.
sure that we have proper insurance and or the best rates for the insurance. And then on an annual basis, we're meeting with our attorneys, making sure that our asset protection strategy and plan is still bulletproof. We haven't like missed any steps. We don't need to do any updating. Having strategy call with our CPA, Usually we do that in November, just to make sure that we can kind of make any changes before the end of the year. And November is usually pretty quiet for these CPAs. But I would say all in all, it's maybe just a couple of hours every month.
Mhm.
Not too much work, just because again, everything is like scheduled. It's kind of foolproof. When we onboard a property, it's, here's the HUD for the bookkeeper. Bookkeeper does their part. And then by usually the 15th or the 20th of the month, we get the P&Ls that we review and just kind of go from there.
Gotcha. Well, yeah, it sounds like a well-oiled machine, right? And you've been able to develop those processes to check all the boxes. I love you mentioned checking in with insurance, checking in with the attorney, checking in with the CPA. I think those are critical things
Mhm.
that maybe don't get talked about enough, but you guys are
Right.
just being proactive in all those places. So
Yeah. It's
yeah,
important for
very
sure.
good. Well, awesome. Well, Jennifer, I appreciate you sharing so much about the inside workings of your business and the strategy and helping people understand how they can build out their own portfolio and
Mhm.
get their own financial freedom, right? And travel to Europe and hey, maybe they'll see you guys while they're out there.
Would love that. Yeah.
So before I let you go, I want to take you through our keys to success round.
Mhm.
4 questions to ask. The first one is, if you were going to invest in someone else's deal and you could only ask them one question, what would that one question be?
Tell me about your worst deal.
Yeah, that's a good one. That's a
It is.
tough one to answer, right? I mean, nobody wants to talk about the skeletons in the closet.
Right. Well, and if they don't have an answer for that, it tells me that they haven't been around long enough to
Oh, that's
experience some, I mean,
that's a good
every
point. There's going to be something, right? You do this long
right.
enough.
Yes.
Yeah, for sure. What are you most proud of in your career?
The freedom that we have, in our early 30s, that we've been able to essentially, build this portfolio, leaving a legacy to my daughter, and just, yeah, having the freedom to basically do what we want when we want to and with whom we want to.
Yeah, I love that. What's a book that everybody should read?
The 4 Hour Work Week by Tim Ferriss. I think I've read it 6 or 7 times. Anytime I feel stuck in any area of business,
Yeah,
I pull out that book, read a couple chapters, and I have my answer.
nice. Yeah, I mean, you guys are living that model, right?
Yeah, yeah.
And then last but not least, what is your number one key to success?
Relationships. Everything is all about relationships. As you had mentioned, it's the who, not how.
Mhm.
And so, again, going back to if I'm ever dealing with a challenge or stuck, rather than focus on the how, like, how am I going to get through this? How am I going to figure this out? It's who do I know that has been here and done that I can basically tap into and help me, figure this out.
Yeah, absolutely. I think that's a fantastic lesson and
Mhm.
something that as an entrepreneur can be difficult at times to
Yes,
one, admit you need help and two, not just try to dive in yourself and fix it right at all
100%.
costs. So very good lessons learned. I appreciate everything you shared with us today. If folks want to learn more about you guys, about your business, it sounds like you've got a network going on. How can they reach you?
Yeah, my website is addictedtoroi.com. And so we have a lot of different resources on the website if you want to learn a little bit more about our model and how we do it. Yeah, it's all on the website.
Awesome. We'll make sure that's linked below so people can access that and find more out about you guys. But Jennifer, thank you so much for coming on the show. And I hope you have a great rest of the day.
Awesome. Yeah, thanks for having me.